December marked half a decade since the beginning of the last recession and 42 months since the recovery began in June of 2009. It would be nice if business cycles expansions never had to end. In some places, they seem not to, like Australia, yet no downturns have been and inevitably in modern economy. Australia's economy can boast more than 2 decades of uninterrupted annual growth, low inflation, and low unemployment. This is largely thanks to structural reforms made in the early 1980s and strong demand from Asia, particularly China. The export-led mining boom has helped to strengthen the Australian dollar. Since early 2009, the dollar has risen by two-thirds against the American dollars to $1.05. But commodity prices have fallen and Australia's economy is now slowing. The country's terms of trade remain well above their long-term average, but they have deteriorated in recent quarters. The strong exchange rate has harmed non-mining tradable sectors like tourism and manufacturing. The mining boom might peak next year. Other sectors like tourism and manufacturing. Other sectors will need to pick up the slack. The OECD, a mostly rich country think tank, encourages Australia to push ahead with structural reforms, keep labor markets flexible, and improve education and training. The economy is strong, but must adapt in order to benefit from Asia's growth and increase its GDP. On average, the United States has grown 58 months at a time during this period, in age of current American expansion. We reached in April 2013. Since the Volcker recession, good time have gone for a longer, 95 months on average. Though the expansion of the 2000s was just 73 months long, a milestone the current recovery will reach in July of 2015. Perhaps the present recovery will more closely resemble and that of the 1990s, which lasted full decades. At the Federal Reserve meeting, Chairman Ben Bernanke announced three thresholds that would be used as guidelines for deciding when to raise the Fed's benchmark interest rate. Based on these guidelines, the Fed's projection for labor market improvement, it recounts that rates may begin to go up around 2015, not, that is, until the economy is firmly within the window in which we would expect no downturn. Without an acceleration in the pace of growth, in other words, the American economy may remain stuck in this trap for more than two business cycles. The Fed's estimate of the economy's full unemployment rate at the pace of job growth in 2011 and 2012, the economy only regained its pre-recession level of employment, about 138,000 jobs, in March of 2015. A new recession may become a risk at a time when the economy has yet to work out the employment problem from the last downturn, and in a world in which the Fed is unwilling to respond as aggressively as the case demands because of its concerns regarding the risk of unconventional policy. If that a pleasant outcome to be avoided, the economy needs faster growth. Faster growth should bring back full employment soon, reducing the risk that billions of us still unemployed will drop out of the labor force, forever carrying Americans' growth potential. Just as important economy that is running harder will generate upward pressure on interest rates sooner, giving the Fed more than ease rates up in order to give itself caution to slash its policy rate into next economy swoon. The Fed often begins of it times is no worry. It is the longer cruising condition persists, the greater of odds that the economy will suffer large and quasi-permanent damage from 2007-2009 recession. Because it is a worry of the day of Washington, it is worth pointing out the current disappointing growth rates and make it harder to establish growth in the government's debt load, while the failed zero interest rate problem means that fiscal policy may have to do more of the job of economic stabilization next time around. Of course, if America is bound to stay stuck in a low growth equilibrium for the foreseeable future, then, like Japan, it may be able to run up enormous piles of sovereign debt with little impact on interest rate. But elected officials squawking about America's fragile future ought to be more worried about present work.